Before we start this video, do like and subscribe to our channel and not miss on any updates.
So friends, ICAI has released the RTP for September 25 exams for CA final all subjects, and today we are going to look at the RTP of Advanced Financial Management paper 2. Now, before I actually get into each of the individual questions and all of that, I want to highlight one thing. This RTP, if you honestly ask me, is actually better than the previous two RTPs what I have seen. Even though most of the questions have been taken from already known sources, right? Almost I think out of 13 odd questions, 10 questions are repeated. Only 3 are new. But even then, the quality of the questions actually seems to be much better than any of the previous RTPs. At least in the last 3-4 RTPs what I have seen, this appears to be far better. Okay, so the one positive sign of commendation for the institute's team who come out with RTP. So let us look at this. And they given each chapter, and this time they have given in alphabetical order. I don't know why such weird stuff. But anyway, let's look at it. The first question is on advanced capital budgeting. Now, this is where they have given, separate revenue, inflation and cost inflation. And then they've asked a bunch of MCQ questions based on that. So, there's a project. The project has certain revenues, certain costs. There's an investment. There's no salvage value. Some depreciation is there. There's a tax rate, and including inflation premium, something is the cost of capital. You are now supposed to find out a bunch of points. Now, this question is straight from study material and what we have solved in class also, which is why I'm not actually going to solve it. This is P600 plus the question number 2, okay, and ICAI SM. Okay, this is very clearly there in our material and what I've solved in classes, as well as what is there in ICAI study material. So there is no great something new that has come up. Okay, so I'm not going to spend time on this. There are questions on which I'm going to spend time. Please, wait. Second question is one on which I'm actually going to spend time. This is on financial policy and corporate strategy. Now, if you guys recollect, they have introduced this new concept of external funding requirement. It was made applicable from May 25. On that, they gave a question also in May 25 where, how to compute an EFR and all of that. Same thing, or probably related to that, they have actually asked a question. And again, this is also an MCQ question, but unfortunately what they have done is, I didn't like the quality of one of the questions, okay, because it was not given properly. But anyway, I'll read out what the question is and then we'll go through it. It's a fairly simple one, you'll see as we proceed. In a recent board meeting of N Limited, following financials of N Limited for the 31st March 25 were presented. Equity capital, so this is already year that is already over. For that, they've given data. Equity 480,000. Okay, so if you take it is probably 480 million or 48 crores, but they've said 48 here rupees 1000 is there, so you have to be careful with that. 10% bonds 92,000, sundry creditors 66,000, bills payable 88,000, other current liabilities 44,000, total liabilities 7.7 lakh. Okay, they've also given the income statement along with the balance sheet. Sales 11.77 lakhs. Material 4.18, wages 2.64, factory overheads 129,800, your gross profit 365,200, S&D 1,10,000, admin cost 1,22,000. So you basically your EBIT is 1,32,400. Then interest charges 9,200 on these on this 10% bonds of 92,000, 9,200. EBT 1,23,200. Taxes at 50% is something. Net profit is something. Now what is it that they're getting at? During the board meeting, Director A said that the company can maintain a certain growth even though the net profit margin remains constant and asset increase proportionately to sales and it distributes 30% of its net profits. To maintain this growth rate, it will not require any external funds. Director B proposed that just by maintaining a target capital structure and without issuing additional equity and maintaining target dividend payout ratio as proposed by Director A, more growth can be achieved. Then Director C said, even though he agreed with views of A and B, but is of the view that in the coming years it is expected that sales is likely to rise by 15% the coming year, that is next year, 25-26. Hence, it is required we can go for issue of equity shares, bonds or debentures to achieve the same growth in sales. Now, first question. From the following information or from the information given above, choose the correct answer to the following questions. Okay, first question. Director A is talking about what? So, what is it Director A is talking about? Before you actually go to what Director A is talking about, please have a look at what is question number 1, question number 2 and question number 3. All 3 questions, if you recollect, we said first go through the questions, then the paragraph or question, the entire case. But here, whatever I say, I actually didn't follow. I first read the case and then came to questions. We have to be very careful. So they're asking Director A is talking about what, Director B is talking about what, Director C is talking about what. And then the fourth question is, if you go by proposal of Director C. Okay, so this Director C, wala fourth question is independent. Now what are A, B and C talking about? See, if you recollect the concepts of sustainable growth rate, external funding requirement, all three of them are talking about those. Okay. Now, Director C is very clearly saying that in the next year there is likely to be a 15% increase in revenue, so we should go for issue of equity shares. What is this clearly? Equity shares or even bonds and debentures to achieve the same growth. So, what is Director C talking about? He is very clearly talking about external funding requirement or financing requirement. So, Director C is definitely answer external funding requirement, not external growth rate. There is no concept called external growth rate. Okay. Now, Director A and Director B. What are Director A and Director B talking about? Director A spoke about certain things and Director B said, that is there and something else also is there. Director A said, company can maintain certain growth even though net profit margin remains constant and assets increase proportionate to sale, and it distributes 30% of its net profit. To maintain this growth rate, it will not require any external funds. What is he talking about? He is talking about sustainable growth rate. But has he covered all aspects? No. Director B is saying, Director B proposed that just by maintaining a target capital structure and without issuing additional equity and maintaining target dividend payout ratio as proposed by Director A, more growth can be achieved. So, if you look at Director A and Director B, both of them combined, because what does sustainable growth rate say? It says you are not raising any fresh debt or equity, then you are maintaining a dividend payout structure or payout ratio, then you have something called a sustainable growth rate, right? So, is A sustainable growth rate or B sustainable growth rate? See, C we have anyway clearly defined external funding requirement. So, this is done. A or B? What are the options they have given you? See, internal growth rate, sustainable growth rate, external funding requirement, external growth rate. But there is nothing called external growth rate. Internal growth rate also I have not heard of. Okay. So, internal growth rate also I have not heard of. So, what do you answer in this situation? See, very clearly B or the question number 2, right, is talking about sustainable growth rate because he has added to the points of whatever Director A has said. Okay. Now, is Director A talking about sustainable, internal, external growth rate, or what is he talking about? See, Director A is only talking about you can maintain certain growth even though margin remains constant, asset increases proportionately and it distributes 30% of its profits to maintain its growth. It will not require any external funds. So, is he talking about sustainable growth rate? Yes. Is he talking about internal fund generation? Yes, he is talking about that also. Is he talking about external funding? No, he is saying no external funding. Is he talking about external growth rate? No, he is not talking about that. So, actually, what they have given answer for question number 1, they have given it as internal growth rate. By the way, internal growth rate is not something that we have heard of this term anywhere in our material so far. But they've given something called internal growth rate. Question number 1 and 2 look very similar. Ideally, this should be sustainable growth rate because you have covered some points of it, and Director B also covered balance points of it. If you are saying Director B is covered balance point and only he can be treated as if having covered the entire concept of sustainable growth rate, then what did he do? Half of sustainable growth rate. If it is half of a sustainable growth rate, is it called internal growth rate? I don't know. I have never heard of that term. Is it internal fund generation? Yes, because you are not going to raise any funds. You are going to use the same net profit for plowing it back into the company and you are going to generate growth. So, ideally, it should be internal fund generation. This is my opinion. Okay, but they have given answer as internal growth rate, which we have not heard as a concept anywhere in our material so far. So, ICAI is ICAI. Despite me giving thumbs up for the quality of the RTP that has gone up, these are the kind of small things that they have made unnecessarily created confusion in the minds of the students. Okay, now these 2 are good, these 3 are over. Now come to the 4th question. Okay, question number 4. Now this is an interesting one. If we go by the proposal of Director C, then approximately dash funds shall be raised in form of equity or debt, assuming that dividend as proposed by the Director A is paid out and assets and current liabilities are increased in the same proportion as increase in sales. So now, first, what is increase in sales? I think we read somewhere, some 15% or something. Sales is 15% and payout ratio is 30%. So, sales is 15%, then dividend is paid out, this is 30%, then assets and current liabilities are increased in same proportion as sales. And they also said something, one more very important thing, which is here, maintaining target dividend ratio. Here you see what Director A said. Net profit margin remains constant. So you have to consider all the aspects what they've mentioned. And what is net profit margin here? If you come and see this divided by this, okay, which is 61,600 divided by 1177,000, you get 5.2336%. Okay, this margin is going to remain constant on what? On 1.15 into 11,77,000 thousands. Okay, 11,77,000 into 1.15 into 5.2336%. You will get 70839, or you can take 70840, 70840. So profit is increasing and your assets and liabilities will also increase. Now please note, this total is 770. These three add up to some number. If you add these two, you get what? 5,72,000. So balancing figure here will be 1,98,000. Correct, no? These three are 1,98,000, this is 5,72,000. Now equity and bonds, we need to find out how much they should increase. Okay, out of that increase, some amount is going to come from your profit, right? Whatever is retained profit. Now, what is the total increase in assets and liabilities? See what they've said. They said assets and current liabilities, everything will go up by the same percentage. So if you see here, the difference between these two, 770 minus 198 will be same 5,72,000. So this 5,72,000, whatever is there, that will increase by 15%. Net number, net assets, that is assets minus liabilities, will increase by 15%. That 15%, whatever increase is going to happen, this minus this, same thing has to happen here. Correct? No. So if you move this 198 here, it will become 572 on the asset side. Same way, liability side will also be 572. If this is going to go by 15%, your equity and bonds also have to go up by 15%. How much will they have to go up to? How much of that is retained earnings? How much of that is debt? We will come to it. But this has to go up. And one more very, very critical point. If you are going to increase your net profit by 5.2336%, whatever this is number is here, right? 61,600 into 1.15, 70840, correct? You have increased it to 70840. You can directly apply the 15% growth rate on net profit because margin is going to remain the same, okay? The key point here is interest also you are increasing. See, if you are going to increase sales, going to increase expenses, going to increase all items by 15%, which is why your PAT is also going up by 15%. Does that mean that your interest is also going to go up by 15%? If interest is going to go up by 15%, what does it mean? If the interest cost of these bonds is same 10%, assume, okay, then your debt has also gone up by 15%. So your debt of 92,000 will increase by 15%, which is 92,000 into 0.15, which is 13,800. So 13,800 is actually going to be increase in debt, which is why your cost of debt is also increasing by 15% and all incomes have also increased by 15%, which is why your profit is also increased by 15%. Very important point, please note. Now coming back, what are we supposed to answer? We are supposed to answer this number here. If you are supposed to fill this number, what is that number? How much of the fund shall be raised in the form of equity or debt? So this 70840 is the net profit. Out of this, 30% retained. Retained is 70%. Paid out is 30%. So 70% of 70840. 70840 into 0.7 is 49588. And if you subtract, you will get 21252. So this is going out of the system. This is what is retained in the system. Now this is retained in the system. How much is the total increase that we require from all the equity and debt holders, or rather how much is the total financing that we require? We require 15% of 5,72,000, which is what? 5,72,000 into 15%, which is 85,800. What I just discussed. That is, you take net assets, move these current liabilities to the asset side and you get net assets of 572 because 770 minus 1, this is 198 only, right? Yeah, 198. You get 572. So that 572, if it is going to increase by 15%, why? Because they said that the assets and current liabilities are going to go up by the same percentage growth as the sales. So this is going to go up by 15. Then your equity and debt will also go up by 15. What is the total increase? 85,800. But out of this 85,800, how much is the internal money that is generated? Internal money that is generated is 49,588. So internal generation, total increase is how much? 85,800. From that, you subtract internal generation, 85,800 minus 49,588, which will be 36,212. This 36,212 already assumes what? That your debt has increased by 13,800. Why debt has increased by 13,800? Because your interest cost has already gone up. Assuming same interest percentage of 10%, your overall outstanding loan should increase. So your debt has gone up by 13,800 out of total increase of 36,212. 36,212 is the total external funding requirement, out of which 13,800 is debt and balance should be equity. Balance should be equity, which is minus 13,800, which is 22,412. 22,412. Okay, now what is the question that they have asked? They have asked, fill this number. If you go by so and so, how much shall be raised in the form of equity or debt? Both together. Assuming dividend so and so is paid out and assets are increasing in same proportion, 36,212. That is what is the number we got. No? What is it? Yes, 36,212. Same number we got. So answer here is 36,212. So answer here is 36,212. Okay, so please keep this in mind. You have to be very careful when you solve a problem like this. On the face of it, it may look complex, but actually it is not. It's actually fairly simple only. Okay, so now let us move to the next question. This is a question in security valuation equities concept. This is a question. This is also a new question. This is new. The previous one, no, this financial policy corporate strategy. This is also a completely new question. Please note. Then we come to this second new question. There are three new questions, as I said in the question paper. This is a second new question. XYZ company has current earnings of 3 rupees per share with 5 lakh shares outstanding. So what is their PAT? 15 lakhs. Okay, I'm not going to solve it fully. This is not an MCQ. Okay, even then I'm going to solve it in a rough manner rather than getting too deep into the solution with stepwise marking and all that. I'm not going to do that. Those solutions are available in the material. I'm trying to help you understand this. The company plans to 15 lakhs, so one more zero. The company plans to issue 40,000 7% convertible preference shares of rupees 50 each at par. So their par value itself is 50. So what is the value of the share? 40,000 into 50 is what? 40,000 into 5 is 2 lakhs. 2 lakhs plus 1 zero is 20 lakhs. So 20 lakhs. Okay, 7% into 7%, which is what? 1.4 lakhs is the preference dividend. Okay, next. The preference shares are convertible into 2 shares for each preference share held. So that is 20,000 shares. For no, not 20,000, 80,000. So each preference share will convert into 2 equity. So 80,000 equity shares. Okay. The equity share has a current price of 21 per share. CMP of equity is 21. Then what is the preference shares conversion value? If you see, we have looked at debenture conversion premium and all of that. I am solving this problem because specifically this is the first time they have actually given something with respect to a convertible preference share. Okay, so which is why I am specifically solving this problem. Then what is conversion premium? It is same as what you do for debentures, nothing different. Assuming that the total earnings remains the same, calculate the effect of issue on the basic EPS before conversion, after conversion. If profits increase by 1 million rupees, what will be the basic EPS before conversion and on a fully diluted basis? Okay, now whether this meets your earnings per share standard FR and all that, I don't know the way they have worded it, but I understand at least what they have in mind. Let us see what it is. So first part is what? What is the preference share conversion value? What is the conversion value? 2 shares at 21 rupees. Conversion value is 42, that's all. Over. Then, what is conversion premium? Market price of a share is 50. Conversion premium. Did they ask it in percentage? I don't know. So we will give manually. Market price minus conversion value, that is equal to 50 minus 42, which is equal to 8. Conversion premium percentage is equal to 8 by 42 on whatever is the conversion value, on that it is a thing. So 8 divided by 42 is equal to 19.05%. Okay, this is second thing. Then assuming the total earnings remain the same, what is earnings? 15 lakhs. Calculate the issue of the basic earning per share before conversion, after conversion. So 3, PAT 15 lakhs. Then this is before conversion. Equity share count, how much? 5 lakhs. Preference shares 40K. Now before conversion, what is the EPS? You have to pay them how much? 1,40,000 as dividend every year. So from this PAT, you will subtract preference dividend 1.4 lakhs. So EAESH is equal to 13.6 lakhs and share count is equal to 5 lakhs. So EPS is equal to 13,60,000 divided by 5 lakhs, 2.72. Then after conversion, if there is conversion, what will happen? This preference dividend will not be there, but share count will increase. So after conversion, PAT is 15 lakhs, share count is how much? You will not have any dividend. Share count is 5 lakhs plus 2 for each share, so 80K shares. So you will divide 15 lakhs divided by 5,80,000. Get 2.59. Now coming to the next question, what are they saying? If profits after tax increase by $1 million, what will be the basic EPS? So profit after tax, PAT 15 lakhs. How much is it increasing? How much is it increasing? By 1 million. No, they said 1 million or 10 lakhs. What did they say? 1 million, which is 10 lakhs. Add increase 10 lakhs. Revised PAT 25 lakhs. Then what is the EPS before and after, on before conversion and on fully diluted basis? So before conversion, less preference dividend, how much? We already computed 1.4 lakhs. So EAESH 23.6 lakhs, equity shares 5 lakhs, EPS 23.6 divided by 5, 4.72. Then fully diluted. Fully diluted means they are converted. If they are converted, PAT is 25 lakhs, share count is how much? 5.8 lakhs. How 5.8? There is no, first of all, there is no dividend. Then whatever you have preference shares, they are converted into 2 shares, equity shares. So 40,000 into 2, 80,000. So 5 lakhs plus 80,000, 5.8. So 25 by 5.8 is equal to 4.31. 4.31, this is the EPS. Okay, so this is a slightly different question. I don't think we have solved this anything like this in CA final AFM at least. Probably would have done some questions like this in AS, EPS, I think AS 20 or whatever the relevant Ind AS is. But I am not really sure if this follows exactly, you've been given, I don't think you've been given all the data that is required for you to actually, solve it properly as per Ind AS and or relevant AS 20. Right. So this is one question that I'm going to solve. Next what question do we have? This is also again a question. This question is from Security Valuation Bonds chapter. This is already an existing question. So P600 plus में question number 2, and it is from ICAI. It is November 18 question paper. Okay. This is what this question is. I'm not going to solve this. You guys can have a look at the question. It is very simple. There is nothing beyond. I am not going to get, it's basically a duration related question. How will you change the duration? How will you immunize the portfolio and all that? Immunization concept. Then you have business valuation. In business valuation, you have, this is P600 plus question number 20, and I say this thing, it is May 19 question paper. It is May 19 question paper. Okay, this also is a equity beta and all of that stuff related question, not very complex. Please go ahead and have a look at the question. Then this 1 and 2, both are derivatives chapter. These are also existing questions. The one is question number 31 from P600 plus, which is ICAI references May 23 question paper, and the second one is on copper, which is number 29, and this is RTP November 23 question paper. This is on P600 plus. So we have already solved this. The reason why I am telling you all of this is we have already solved this in class, and I see no point in solving all of them further again. This is interest rate risk management. This also we have solved in class. This is question number 16, and it is RTP May 21. So those of you who are aware of this P600 plus, great. If you're not aware, please visit the link below, where in the description in the video below, where I have actually given the P600 plus ka direct link. It's a PDF that I give it on website free of cost. Any of you can download and use it. Okay. Then you have a portfolio management chapter question. This is question number 30 from P600 plus, and it is ICAI steady material question. Now, question number 8, right? Even though it is very similar, there are small changes in the way the solution has been done. Solution changed, okay, compared to SM. They have introduced a concept of joint probability and all of that. So we will look at it. So if you look at this question number 8, right, we'll look at what change has been made. Mr. A, HNI investor on 1/4/14 has invested in certain equity shares as below. X Limited, 1 lakh shares of 100 each, cost is about 2 crores. Y Limited, 50,000 shares of 10 each, about 1.5 crore. Total investment is how much? 2 and 2 plus 1.5, 3.5 CR. Okay, then what have they said? In September 14, 10% dividend was paid out by X, and in October 14, 30% dividend paid out by Y. Okay, on 31/3/15, market quotation showed a value of 220 and 290 for X and Y. Okay. On 1/4/15, a technical analyst indicated as follows: the probabilities of dividends from X Limited and Y Limited for the year ending 31st March 16 are as follows. So we've got some data for 15, 14 to 15, and then 15 to 16. When did they invest? He invested on 14. So 14 to 15, one investment, one cycle, 1 year, one financial year, then 15 to 16 next year. Probabilities of dividends from X and Y for the year 31st March 16 are as so and so. This is the probability, this is the dividend. This is dividend from X and this is dividend from Y. Then the probabilities of market quotations are also separately given. There's a probability, there's a price of X, then there's a price of Y. You are required to analyze the average revenue from the portfolio for the year ended 31st March 15. Analyze the expected average return for the portfolio for the year ended 2015-16. That is, first year is okay, then next year. Then advise Mr. A of the comparative risk in two investments. Now you see what has happened is, this part, no, they have done the same way, no change. Answer is also same. Part 2, there is change in solution, working is different, eventual conclusion is same. Part 3, again working is slightly different, but conclusion is same. Conclusion and answer same. Here only conclusion same. Okay, here everything same. I'll tell you what I am referring to. Okay. Analyze the average return for the portfolio for the year ended 31st March 15. So what is 15? 15 may you've already got something. You've got a dividend here, both of them, and you've invested 2 crores and 1.5 crores. Now, if you look at the dividend, what is the dividend? It is 10% dividend was paid out on X paid out by X Limited in October, and 30% was paid out by Y. So 10% and 30%, correct? 30 or 3. 10% was paid out by X and 30% dividend was paid out by Y. Now 10% on what? 10% on 100 rupees. That is, you purchase 1 lakh shares on 10% of 100 is 10. So 1 lakh into 10, which is 10 lakhs. And here you had 30%. 30% of 10 is 3. So 3 into 50,000 is 1,50,000. Per share here you got 10 bucks. Per share you got 3 bucks. Okay. What is the closing value? 220 and 290. they've already given the values. Cost of investment, you invested when it was 200, you invested when it was 300. Then what is the gain loss? Basically based on purely the capital gain on the price of the investment. So here you gained 20 bucks, here you lost 10 bucks. Then you got how much as yield? Basically get 10 plus 20, which is 30, is the total overall return including your capital gain and dividend. Here 3 minus 10 is minus 7. And your cost is what? 200 and 300. So the if you look at return percentage, right, 30 by 200 and minus 7 by 300. So you basically will get 15% and minus 2.33 and minus 2.33. What is their weight in the portfolio? The weight in portfolio is very clear. 2:1.5. That is 2 by 3.5 is how much? 57.14. Yes, 57.14. Balance is 42.86. So you multiply these two with these two percentages and you'll get 7.56. We did the same thing in the study material also, okay, or even what we solved in the class also. But next point is where the changes. Let me show you what the study material thing is. Now you come to the study material. Study material also, if you see, you have the same 7.55. Now this is where the change happens when you come to the second part. What is the second part of the question? Second part of the question was average return from the portfolio for the year 15-16. For that is for the next year, what is the average return? And the problem with next year average return wala logic is, next year what is average return is, you have been given probabilities here for next year's dividend for both of them. You've been given probabilities for next year's price, okay, closing price. Now if you look at what they have done as answer in RTP is they have computed something called as joint probability, that is dividend. Okay, what is the probability for dividend? If you look at the probability for dividend, 0.2, 0.3, 0.5. For X is 10, 15 and 20. 10% of 100 is same 10, so it doesn't matter. Whereas for other one, for Y, it is 10 rupees share, so it is 15% of 10, which will come to 1.5. Okay, remember that. What have they done? 0.2, 0.3 and 0.5. So first they have taken 0.2 and probability and the dividend is 10. Okay, 10, 10, 10, 10. Okay, that is the dividend income. And what is the gain in market price? Market price, probability same 0.2, it can be 220, 250 or 280. So for each one of them, they have computed separately. Now I am talking about company X. What they have done is take 3 dividends, 10, 10, 10. Okay. Closing price could be 220, 250, 280. So in each case, the gain from market price will be different. Then total return, okay, is 10 plus 0, 10 plus 30, 10 plus 60. You arrived at some number. Now what is the joint probability for this? You have for dividend to be 10, it is 0.2. For this price to be 220, it is 0.2. So 0.2 into 0.2 is 0.04. 0.04 into 10 is 0.4. Like that, they have arrived at expected yield based on joint probability. Okay, same way. Now you see for this 10 of dividend, no, is always probability is 0.2. Whereas for these three, 0.2, 0.3, 0.5 and 0.3. So they multiplied by 0.5, they multiplied by 0.3 and arrived at joint probability, multiplied the total yield or return by joint probability to get the expected yield. Like that, they have done for all 9 scenarios for X. Then they did the same exercise for Y. When they did these two, they have got what return? Expected yield in rupees is this much, market value on opening is 220, so the total return is 22.5%, 22.5 and 8.5. Now, if the expected returns are this much, then weights in the portfolio are how much? Previous year ka jo bhi closing number, you have to take that. Closing number is 220 and 390 because for stock X, it went from 200 to 220 and stock Y, it fell down from 300 to 290. That is the weight in portfolio. So 60.27 and 39.73. With that ratio, you multiply 22.5 and 8.5, you get a return of 16.94. This is what is the new solution in the RTP. What is the old solution that is there in the study material? I will show you. Old solution was expected dividend. Directly take, okay, directly take what is the dividend multiplied by the probability and get an expected value. That's all. How do you get expected dividend and value? See here, they multiplied 10 into 0.2, 15 into 0.5, and I think the third dividend was 30, 20. 20 into 0.3. This is 2, this is 7.5, this is 6. which is what, 6 plus 2, 8, 15.5. I think this is 0.3, this is 0.5, my mistake. 0.3 and 15, 3 is 4.5, and this is 10. 10 plus 4.5, 14.5 plus 2, 16.5. Whereas, if you look at this original question, right, in the study material, they have not given probabilities for your dividend. There they directly gave dividend is going to be 20%, 30%. So, you directly took these values, 20%, 30%. And you did what? Whereas, they gave the probabilities for closing price. So, you multiplied the respective probability with respective closing price and arrived at a certain capital gain. What is the capital gain? Expected closing price, subtract minus opening price. So, you get some gain. This is how they did in the previous question in the study material. Whereas, what have they done now? If you look at this, because there are probabilities for both of them, you took joint probability and arrived at a certain number. And using that certain number of joint probability, you multiplied with the return, got the expected return, summed up all the expected returns for all the probabilities, and finally got an overall expected return. Based on that, you have computed. So, this is a change. So, please note, when institute makes such kind of changes, it is very important that you actually keep this in mind and proceed accordingly. Probably they may have an intent to ask such kind of a question sometime soon, which is why they have made a change. So, please, nobody can know what they want, but when they made a change, please keep this in mind. Next, coming to analyze the risk of each investment, we need to calculate. Now, when you compute the risk of each investment, here also, they have computed again joint probability. Whatever joint probability numbers have come here, right? 0.04, 0.1, 0.06. They have taken the same numbers here, and they have taken the yield. Yield is 10, 40, 70. You see here, we've got the same thing, 10, 40, 70. I'm referring to both the probability and yield. This is the product of both. So, ignore the product, come to each individual number. So, each individual number, 0.4 into 10, okay, like that they have got probability and yield. Now, then they computed the deviation. How do you do the compute the standard deviation sigma where there is probability and where there is a different yield? You use you compute the mean, whatever is the mean. What is the mean? We arrived at a mean number here, no? What is the mean here? 49.5. So, you subtract 10 minus 49.5, you get minus 39.5, then square it, then you multiply each one with the probability. So, you multiply this with this probability and then sum all of them and then take a square root. You get a value of 21.36. Now, I will come back to this again. Same way for standard deviation for y also, you take the probability, you take the yield, whatever is the expected yield. What was the expected yield that we computed previously here? 24.65. So, you subtract from each one of them 24.65. 1.5 minus 24.65, you will get 23.15. Like that you do for each, then square all of them, then multiply the square with the probability and sum it up, you will get 196.75, you will get basically 14. Now, if you come back and look at the study material, because no dividend ke liye there was no specific probability, you actually computed everything based on one single expected yield only, and they did not use any joint probability wala concept. So, directly you got 21 and 14. You got the same answer. 21 and 14. But you got the same answer 21 and 14. But you got it because of different working. Okay, you got different working. 14.03, 21.36. Answers are very close, but you got different working. And what is the eventual solution? Although higher return is expected in case of X, it also has higher risk. What is the specific question they asked? Analyze the investment, right? That was the specific question. Analyze the risk of each investment. We need to calculate the standard deviation. So, X return is what? X return is 22% and standard deviation is 21. Y return is what? Return is 8.5, standard deviation is 14. Okay. So, you actually have although expected return is high in case of X, but it also has higher risk. Okay. Now, you can actually compute coefficient of variation here also and then give answer. What is coefficient of variation? Your standard deviation by mean. That is per unit of mean, how much is the standard deviation? And if you see that 21.36 by 20, this is by 22 only, no? Yeah, by 22 and a half versus 14 by 8.5. So, you see standard deviation by mean, per unit of mean, how much is standard deviation? If you look at this, actually X has lower standard deviation, whereas Y, even though it is giving a lower mean return of 8.5, it has a higher standard deviation of 14. So you can actually use this for answer. They have not given in the material, they have not given in RTP, but I would, if you ask me, I would actually not only say make this statement, but I would also make this statement, coefficient of variation. So a lower coefficient of variation is better, higher coefficient of variation is bad. Okay, this is question number 8. Then comes this Forex chapter. Forex chapter mein this question is new. I am going to solve this. Okay, this is new. Let me come back to this. Let me finish other questions and then we can solve this. Then you have the second question. This is JPY question, Shanti exports and all that. This is question number 71 and MTB October 21 question. This we have solved this in class, nothing fancy. They have only changed the rates. They have made the rates, I think it's 60, 65 something in the question originally. Now it is changed to 20, 80 and 81. Then you have M&A. M&A also fairly simple question, nothing complex. Question number 43, and in our MTP it is April 21. This one was what? The Shanti 71. I told that, correct. Then mutual funds chapter. Mutual funds also same question. We have ditto number 15 and MTP March 21. Okay. Then finally, international financial management. This actually is not an IFM question. This is actually a Forex question. Forex question number 35 and MTP March 21. Okay, this is not the IFM chapter. This question was actually there in Forex. Then, what is a unicorn startup? Who coined the term? Who coined the term? Who will remember, boss? But anyway, it is there in the what their question is. Secondary participants, basically your paying and receiving agent, your trade trading agencies and all of those. Briefly explain various market indicators used in technical analysis. I have explained this in class, your breadth, confidence index, then, relative strength, advances and declines and all of that. Then how buy-in signals are, sell signals are provided by moving average analysis. So if the daily moving average cuts the price from below, if it is from above, all of that. There's a bunch of stuff around this. I've explained this in class, you can go through. Discuss parameters to identify currency risk. Now this is an interesting question. I actually wanted to see what answer they gave. See, I was saying agent, credit enhancer, structurer, then receiving and paying agent. This is the first one. Breadth index, volume, confidence index, relative strength, odd lot. See, buy and sell. Stock line rises through the moving average when graph is of the moving average is flattening out. If it is increase, what is buy, what is sell, they've asked. Then parameters to identify currency risk. How will you identify currency risk? Government action. Okay. Or nominal interest rate, inflation rate, natural calamities, war, coup, rebellion, and change of government. These are the aspects which impact or have or cause currency risk in the currency exchange rates. Okay, so these are the things. Now coming back to that question which we left, question number 9. What we have wanted to solve, the other question on Forex. On 1st February 25, XYZ Limited, a laptop manufacturer, imported a particular type of memory chip from SKH Semiconductor of South Korea. All this story irrelevant. Import, that is the important thing. Payment is due in 1 month from the date of the invoice. So you would import it on 1st February, 1 month on the 1st March. And it is amounting to 1190 million SKW South Korean won. It's called as 1 Korean won. Following spot exchange rates of 1st February are quoted in two different markets. What are the spot exchange rate? USD by INR. Again, this is what I keep saying. USD by INR, this is natural market convention. That is, the base currency is put first. But what is the understanding here? When you see this 85 and a half rupees per dollar. Rupees per US dollar. 85 per $1. So same way here it is Korean won per $1. This is what this means. And if you have 85 rupees per dollar, whereas 1300 Korean won per dollar, it means that rupee is stronger than Korean won. Okay, so that is the first aspect. Then, and they have given both bid and ask, we'll come to that. Since hedging of foreign exchange risk was part of the company's strategic policy, and no contract for hedging in SKW was available at any onshore market. No, it's not called inshore, right? It's called onshore. Onshore market, meaning in India, this particular company, what is the name of this company? XYZ was not able to hedge based on for its exposure in Korean won. So what did it have to do? It could not hedge it within the country. What did it do? it approached an offshore non-deliverable foreign market for hedging the same risk. So they started NDF. They went into an NDF market. If you remember, I explained this in class. What is NDF? Non-deliverable forward. Basically, you enter into a forward contract outside the country, and they themselves have said no offshore market, and there is no delivery. So you'll make cancellation, and there will be a gain. That gain you can bring it back. How you will bring it back, whether it is legal, illegal, all those are independent. But there will be a gain. In NDF market, a dealer quoted 1 month USD SKW at 1390 by 1390.6 to be settled at reference rate declared by the Bank of Korea. So you see 1390 by 1390.90 is what was there, but in NDF it is 1390 by 90.60. Okay, after 1 month, that is 1st March, the dealer agreed for SKW 1385 USD as rate for settlement. So the settlement rate is 1385 per USD. Okay, we will see, we will understand this more carefully. On the same day, the spot rate in the above markets were as follows. On the same day, spot rates 85.50 and 85.75 and 13.88 and 13.88.6. Okay, this is in Mumbai, this is in New York. Analyze the position of the company under each of the following cases, comparing the spot position on 1st February. Compared to spot, you please analyze. Do nothing. What will happen if you do nothing compared to spot? That is, if the spot was this, you didn't do anything, on 1st March something happened, compared to 1st February, did you gain or lose on 1st March? That is what they are asking. Compared to 1st February, did you gain or lose on 1st March? Okay, if you don't do nothing or if you opt for NDF. So one case you don't hedge, other case you hedge. Both rupee SKU rate and final rate to be computed in rupees lakhs and be rounded off up to 4 decimals. 4 decimals is okay, rupees lakhs is also okay. And what is this? This is million, no? They have given something, 1190 million. So let us see. I will keep the question open here so that I can keep flipping it. So, import payment. South Korean won 1190 million. Okay. Now this is due on 1 March. Okay, which year? Have they mentioned any year? 25. On 1 March 25. Okay. Now if you look at this, right, import payment by Indian. Okay, XYZ is an Indian company. You have to repay 1190 million. Okay, you don't have one. You have to buy one, but one is not traded. Okay, so on that day, okay, you don't know, I mean, you can't get a won in India, but you can get outside India. How will you get outside India? First you buy dollar, then you sell the dollar and buy the won. So first action, buy dollar, and I'm looking at no hedge, right? They said first no hedge. In no hedge scenario, buy dollar. When am I referring to? I mean, what is it that I'm doing? Am I computing the value on 1st Feb or 1st March? First I will compute on 1st Feb, where I will say what is it in rupee terms, because this is in Korean won terms. I need to know what is my exposure or what is the value of the imports that I have made in rupee terms, INR terms. Then I will see what is the payment on 1st of March, whether there is an increase, whether there is a decrease. No hedge, so 1-2. On 1-2, I will buy dollar. What is the dollar exchange rate they have given? 85.00 by, what is it? 85 by 85.50. 85 by 85.50. So bid, ask, banker bids to buy the base currency. You want to what? You want to buy dollar. Banker is bidding to buy the base currency. So the banker will offer to sell the base currency. So you have to buy it at 85.5. So 1 USD is equal to rupees 85.5. Then you will sell the dollar. What is the base currency here again? Selling the dollar. When you are selling the dollar, there also the base currency is dollar only. Base currency is dollar. So you have to sell the dollar. Banker bids to buy the base currency, and here you are selling, means banker is buying. Meaning which code is relevant? The bid code, because banker is bidding to buy the base currency and you are selling the base currency of dollar. So 1390 is what is applicable. Sell 1 USD. This is buy 1 USD. Sell 1 USD at 1390 Korean won. So INR won exchange rate, that is INR per 1 USD into 1 USD, how many South Korean won, will give you the exchange rate of for one South Korean won, how many INR? Correct? So subtract this to for 1 USD, how many INR? 85.50 into, for 1 USD, 1390. For 1 USD, 1390 South Korean won. So into 1 by 1390 will give you, for 1 South Korean won, how many INR? It will be 85.5 divided by 1390. You will get 0.061510. They said only 4 decimals, right? Okay, thank you. So 1 South Korean won is equal to 0.0615. Okay, what? Rupees. Okay, now how many South Korean won do we have? We have 1190 million South Korean won is equal to how many rupees? 0.0615 into 1190. This is million. I have to convert this million into lakhs. That is one more zero, 11900. I will get, that is rupees 731.85 lakhs. 730.85 lakhs is my import payment on, or import liability, not payment, liability on 1st February 25. Haba, one activity is done. Now, what have they asked? If you don't take any action, what is the gain or loss on this? So, on 1st March 25, what are the exchange rates? 85.50 and 85.75 and 1388 and 1388.60. What are the relevant rates? You will have to buy again at 85.75 and sell at 1388. So, again you see, in previous case what did we do? We took 85.50 and 1390. Same thing will happen, no? If instead of doing it on 1st March, you crystallize your liability on 1st March at 730, whatever, 731.85 lakhs. But actual liability on due date is what? Actual liability is 85.75 by 1388. I am not again doing the whole what is bid, what is ask, all that story. By 1388. 85.75 divided by 1388. That's equal to 0.61779. So I will take 6178. Okay. So INR payment is equal to 0.6178 into 11900 million. This is won. This is number of INR per 1 Korean won, and this is Korean won. So Korean won gets cancelled, you get in lakhs. 0.6178. 0.6178 or 0.06, what is this? 0.06178, so I will take it 18. This is see, this is where I made a mistake. That is what I was wondering. Where did I make a mistake? So I will round it off as 0.6178, 618. It is rounded off 0.0618. 0.0618 into 11900 into 11900 is 735.42. 735.42 lakhs. Initially, you recognize the liability at 731, whereas now the liability has gone up. So, if no action taken, then Forex loss is 731.85, no? 85 minus 735.42 is 3.57 lakhs. Now, this is first aspect. Second aspect is what? Second, you take an NDF. If you take an NDF, what is going to happen? See, in NDF, a dealer quoted 1 month USD SKU at 1390 by 1390.6. What are you going to do? If you take a 1 month, NDF, are you going to do the rupee dollar transaction and then dollar won, or only going to do dollar won? You getting my point? Are you going to do both the legs, or are you going to do only one leg? See, in NDF market, one leg is only done. But will you do the other leg in India? No, you will typically do this, you can do both legs. I mean, you can do the one leg there, one leg here. But in this particular question in the material, they have solved as if only one leg is hedged. I hope you have understood what I am saying. See, in previous case, we did one transaction in INR USD, other transaction in USD Korean won. When you do NDF also, will you do INR USD in India and USD and Korean won in outside India? Or will you only do USD Korean won outside India? If you look at the solution, right, they have assumed that only one leg, only the USD Korean won leg is hedge is entered into, because they have not mentioned anything, no. Opting for NDF. When you opt for NDF, there is a possibility that you will also hedge the local leg, no? Correct. So they have not said that, but anyway, we will assume that that leg is not hedged. You are only hedging the NDF leg. Now in NDF leg, what has happened? 1390 by 1390.60. What did we do initially? Initially we took the bid rate. So here also bid rate only will be relevant, 1390. Then closing rate is what? Closing rate is 1385 is the closing rate. That is, you have agreed to do what? You have agreed to sell $1 and buy Korean won at 1390. That is, for $1 if you sell, you will get 1390 Korean won. That is what is the original NDF. Correct? I am just cleaning this up. Original NDF was, you are first buying dollar by selling rupee, then you sell dollar and buy Korean won. If you sell $1, you get 1390 Korean won. Subsequently, at closure, the rate is changed to 1385. That is, when you first you agree to sell dollar. Now, when you have to buy dollar, you have to give only 1385 Korean won. So, you have made a gain. You have made a gain. Why? Initially, when I sold $1, I got 1390. When I have to buy back the dollar, I have to give only 1385. So I have got that 5 Korean won per dollar. I have made a gain. Correct. But what is the contract for which you have entered into? You have entered into for 1190 million Korean won. So let us see. NDF only USD SKW leg is hedged. Then buy SKW and sell USD at 1 USD for 1390 SKW for 1190 million SKW. Okay, each USD gives 1390. For 1190 SKW, how many USD are required? 1190 divided by 1390, okay, into 1 million. You sell 856115.11, sell USD and buy 1190 million SKW. On due date, what are you going to do? See, on due date, is your exposure in rupee, is your exposure in SKW, or is your exposure in dollars? What are you trying to close? See, you have agreed to sell at this, you have agreed to buy this. On due date, when you are squaring of the transaction, are you reversing for this or are you reversing for this? What is the known number? You need to reverse for this. So sell 1190 million SKW at 1385 SKW per USD. So how many will you buy? So if you sell this, you will be basically buying USD. How many USD will you get? 1190 by 1385, okay, into 1 million. You will buy 205.78 USD. So you initially sold this much, you later bought this much. So what is the gain? 859,205.78 minus 856,115.11. So your gain, that is you are left with this many USD minus 856,115.11. You are left with 3090.67 USD. So this is the USD that the company is left with. Why? Because I have first I purchased, what did I do first? I bought SKW and sold USD. Okay, I have sold off less. Okay, for the say, and whatever I bought, whatever Korean won I bought, I sold it off, and I got more USD. Now I have more USD with me, and whatever I sold, I got more than that. Right, so I've got more. So how much more? 3090 US dollars. Now 3090 US dollars is what is my gain in US dollar term. Now what is it in rupee term? On that day, this I will convert it into rupee. If I sell dollar, I will buy rupee. If I am going to, and dollar is the base currency. If dollar is the base currency, banker will bid to buy the base currency. So bid rate is applicable. What is the closing bid rate? 85.5. So I will get 85.5 into 3090. Okay, gain in INR on NDF. 3090.67 into, how much was that? 85.50 into 85.50. That gives you how much? 264252. Okay, 0.95 is there, and round it off. 264252. 264252. Okay. Then on that day, I have got NDF, but I have to still make the payment. No, I have to still make the payment. At what rate will I make the payment? I will make the payment at the spot. What is the spot? I think we have already computed here. Where is it? What is the spot? We've already computed in the previous case. No, at spot rate, the payment is 735.42 lakhs. So this is plus less payment, 735.42 lakhs. So net payment, 735 minus gain, no? 735.42 minus 2.64. Okay, I am converting this into lakhs. So your net payment is 732.78 versus original liability was what? 731.85. 731.85. So net loss is 0.93 lakh. Now can we give it in 2 decimal, 3 decimal or 4 decimal? They have said specifically what was the exact wording that they gave? Rupees lakhs to be rounded off. Acha, so rate and final payment both. Acha. Okay, I missed that. So even the payment also, no, should be in not in 2 decimal, it should be in 4 decimal. I missed that point. I was thinking somewhere I saw it, but I was confused. Okay, anyway, you don't be confused. Everything has to be in 4 decimal. See, in this entire thing, no, you have to understand how this NDF works. How do you square off a position, whether you make a gain or loss, bid, ask, what do you buy, what do you sell. If you have understood, then this particular question is solvable. I really appreciate the institute for having added a question like this in our RTP. It's a very good quality question that they've added, which is why even though there are 2 or 3 mistakes which I highlighted in one of the first or second questions, on an overall basis, this particular RTP looks very decent. Okay guys, so this is the summary of the entire RTP. I have solved 4 questions. One question slightly with respect to portfolio management only, I've shown you the solution because there's a change in the solution. Other 3 which are completely new, we have solved them right now. Okay, so if you have any doubts, queries, feel free to reach out to me. If you have any comments, please share. Please do like, subscribe to our channel. Please share this video, and I hope that you succeed in your September 25 exams. All the very best.